This is episode 275 of Zen and the Art of Real Estate Investing with my guest, Kent Ritter. Kent is the Chief Executive Officer and founder of Hudson Investing, a multifamily real estate syndication firm. They acquire, manage multifamily real estate investments, you guessed it, helping investors build wealth through strategic property acquisitions. Kent is also the owner of Hudson Capital. Kent, welcome to the show.
Thanks, Jonathan. Appreciate you having me on today.
Yeah, excited to talk to you. And I'm always excited to talk multifamily. And I always tell all the multifamily syndicators and investors that I do a lot of multifamily shows, but it's still interesting to me how they're always different. What do you find most interesting about multifamily real estate investing in the syndication world?
Yeah, that's a really good question. I think it evolves all the time. I mean, one thing I love about real estate is there's just so many aspects to it and so many ways to constantly be improving your craft and things that you focus on, whether it's combating, operating expenses or interest rate moves or, whatever it is in that certain day. But I would say interesting, for me right now, it has been deeply diving into property management
Hmm.
because we just brought all of our property management in-house. So we went from, having third parties manage for us and through about a 10-month effort, brought our entire portfolio in-house. So it's been just really gratifying, really educational. It's always cool for me now where I am in the business to be able to be kind of the strategic leader, but bring in subject matter experts into these different verticals, which is what we did for a property management company. We
Yeah.
brought in folks with 30 plus years of experience to lead the firm and then just really build a team around them where I'm able to kind of take my strategic mindset, my years of like management consulting background, and just challenge folks with great experience to think a little bit differently and just see that unfold. And it came together in an amazing way for this new property management company. So
Yeah.
that's like what's most interesting to me right now, because when you think about like what I've learned over my 10 plus years of real estate investing is nothing drives performance or can make or break a deal more than the boots on the ground property management and the people that are day to day interacting with your clients, right? Your residents. And so just taking a deep dive into that, learning a ton and building that out is really what's interesting to me right now.
Do you think that this is going to
That's right.
take hold for these younger people who are making money and like they're not going to sink it into a house and they might want to sink it into a syndication if they're accredited and earning a lot?
I hope so because, I would say, look, I'm happy for all the experiences I've had, right? But, the whole journey I went on of single family house
Yeah.
flipping
Uh,
and owning single family rentals and self managing and all that. Uh, I wish I would have spent all that brain damage just focusing on multifamily
yeah.
and on syndication. Cause I mean, I learned a lot, but you take a lot of lumps, and that is a very risky strategy. Like house flipping, especially because I mean, even today, this was 10 plus years ago, the margins were better,
Yeah. Oh
right?
yeah. Yeah.
And if you don't think flipping is an absolute 80-hour plus a week
Oh
job, then you haven't
yeah.
done it.
I agree.
Um, and then managing a bunch of single family rentals is also, you get to a certain amount where your phone's there's always an issue just because you've got so many of them.
Yeah.
And so for all those reasons, like I try to tell people, because I have people come to me all the time. Maybe they're listening to my podcast or I just meet them and they hear what I do and they say, "Hey, I'm thinking about buying a duplex. Or I'm thinking about buying a quad or this." And I'm always like, look, it's not as easy as you think it's going to be. It's way harder actually.
Yeah.
And what do you do now? Okay, you're a high earner. How many years have you spent doing that? Okay, you spent 15 years learning your craft, right? You're in your peak earning years. Why are you going to go buy yourself another job,
Exactly.
right? Focus, because that's what you're doing. If you're buying a single family or any type of rental, you're buying yourself another job. How much time do you have to commit to that? Do you want to? Do you want to be doing that after hours because you're working full time? And I'm like, look, you've spent forever focused on what you're great on. Go earn as much as you can doing what you're great at, right? You're not as passionate in real estate as I am, because the thing that I didn't expect was I fell in love with real estate and
Yeah.
like went all in. That was not my original plan, but I just love it. I love the deals. I love all that. Like you're not investing as much money in it or as much time in it as I am. You don't have the team of 30 plus year experts that I
Yeah.
have. And so like, let me focus on your real estate and just send you a check, right?
Yeah.
That's the whole model, right?
Yeah.
You make the most money over here. You deploy some of that with me to be well diversified. I don't want all your money, right? And then let me get as much out of that as I can, and you don't have to think about it again. And that
Yeah.
I think is the best model for everybody to be successful.
Where did you start and where are you focused now in terms of geography? And then we'll get to, what unit count is attractive to you because it's really different for all operators in terms of what they're looking to buy.
Sure. Yeah. So geography, again, started very practically. Just I live in Indianapolis. And so we started in Indianapolis.
Yeah.
And so that was really the focus. I did invest some in the Southeast just through some partnerships and through other folks I had met where they were boots on the ground as I was getting started. But as we really brought Hudson Investing together, it was, let's focus on core Midwest. So most of our properties are in Indiana, Ohio, and Kentucky. And we've got, we did do some, we were looking more in the Southeast, as everyone was over the past
Yeah.
5 years. And we have an asset in South Carolina that's doing well. But really, as we decided to, with the management shift, especially, and just everything that's happening in market dynamics, the Midwest is really on the upswing. The West, Southeast, because of oversupply in many markets have been kind of down. And
Yeah.
so we said, wow, well, we've got these great market fundamentals in our backyard. So let's really hone in on the Midwest. And so that we've kind of we started here, we went out, and now we're kind of back.
Yeah.
So that's how it's evolved over time.
So it is really important, as you were saying, to know what the income generation is there, what the spread looks like for them, so that when you provide it, but there's always going to be some turnover. But I think everybody in general, even down to D market, they want a better product. It just has to match what their income profile is.
That's right. You gotta be able to really add value for it. And yeah, I think that's one of the biggest mistakes investors make is overspending. And I think through experience, the ability to really separate yourself from from the renovation. Because
Yeah.
you can say, oh, I really like that backsplash. It's like, well, you may like it, but it's not in the budget, right?
Yeah.
What we look at is return on cost for construction, and we're looking for that to be in kind of the 15 to 20% range. And meaning the rent premium we're getting relative to the cost. And so that is really a metric that allows us to very objectively control what we're spending and not get overly excited about finishes and things. And so
Yeah.
I think in that way, we're able to control that. Like I said, the property we're acquiring in Fort Wayne, the thing I've told the team is that, look, the worst thing we can do here is overspend. So we need to be very mindful on what we can keep and save and is still in good quality. And we need to fix around that. But the last thing we want to do is price these people out of
Yeah.
where they're living.
Yeah, it messes up the community. It was funny though. If you go back to both of our flipping days, that's when you can make a excited tile choice then because it's just one bathroom. I mean, like okay, you spend 400
Yeah.
extra bucks on a bathroom. Maybe you didn't get the ROI that you wanted out of it, but if you make that across 100 units, you're in trouble.
Yeah. And so you just have to understand what really creates value. What creates value and what is just kind of aesthetics, right? And I think, that just comes through experience. And so, I mean, right at this point, we've got it dialed in. Like we know, I mean, we basically have three renovation tier. We got a C tier, a B tier, and an A tier, and we know the products that to the specific items, what
Yeah.
they cost, what the package is, and we know what's worked well from paint colors, floor colors, different fiction. We've done the research through
Yeah.
what's worked and what hasn't in real life, and so we've been able to really dial that in.
Yeah, I mean, you're creating a new canvas for someone that's basically not offensive to anybody for renting. I mean,
Yep,
you can't like, have
that's right.
7 accent walls. Sure, you can throw one in here and there, but generally you just want to make it so nobody has an objection when they come in. Maybe they're not like, this is the greatest place that I've ever seen in my life. It's not flashy, but it's like, wow, I mean, this
Yeah.
feels great. And I can add my own touches, which is, I think, what most people want in any home, whether they're renting or buying.
That's right. That's right. I mean, I think we look for kind of a classic style with a little modern twist and yeah, very, very neutral, right? Appealing to all. And I think and then I think something I've learned over time is if you're going to spend money on the things that people touch and interact with every day.
Yeah.
Those are like doorknobs, cabinet pulls, faucets,
Yeah.
you know, thermostats that don't break. But if you think about, just even subconsciously the signals that you're receiving, if you're touching a door, oh, this feels chintzy, or,
Yeah.
your faucet, oh, this thing kind of jiggles and doesn't feel quality. I think those things that you touch and feel every day are things that like give those quality signals.
Yeah.
Things that where those are areas where I will pay up on, like a nice faucet is a centerpiece that just is going to last long and feels like it's high quality.